Hello, good evening to all of you. Today, I would like to discuss the risk and return. As we know, that when we want to invest as an investor, as an as a rational investor, we have to consider two factors, that is risk and return. As we know well, that whosoever is an investor never want to take more risk and always want to get higher return. But level of investors is not same. Like my father, my grandfather, me, maybe my children. My grandfather will never invest money in such a market where there is high risk. If we suggest our grandfather to invest money in stock market, they may say, can you write on a stamp paper that you will give me return at fixed rate every year? I told my father, sorry, that I cannot write. Then my father told me, then stop advising me. Don't tell me that invest money in stock market. I'm happy with 4% interest after investing my money into bank, because I know I will get 5% return without any risk. So he's told me, okay, if you want to invest, okay, if you expect higher return, take risk, invest wherever you want. I don't have any problem. But don't advise me, because I'm happy with 4% and I don't want to take any risk. So, any rational investors, before investing his or her investable wealth in the stock, analyze the risk associated with the particular stock. The actual return he receives from a stock certainly may vary from his expected return, and the risk is expressed in terms of variability of return. It means there is a variations in the return. Variations in what? The expected and actual. So the downside risk may be caused by several factors, either common to all stock or specific to a particular stock. Investors in general would like to analyze the risk factor, and a thorough knowledge of the risk helps him to plan his portfolio in such a manner so as to minimize the risk associated with the investment. Now, what is risk? As a layman's word or in a dictionary meaning of risk is possibility of loss or injury, the degree or probability of such loss. In risk, the probable outcome of all the possible events are listed. Yes, certainly, yes. The probable outcome of all the possible events are listed. Once the events are listed subjectively, the derived probabilities can be assigned to the entire possible events. For example, the investors can analyze and find out the possible range of return from his investment. He can assign some subjective probability to his return, such as suppose 50% of the time there is a probability of getting 2 rupees per share as dividend. I'm expecting 2 rupees per share as dividend and the probability is 50%. Then the rest probability of 50% is what? Maybe to get 3 rupees per share. So, often the risk is interchangeable, used with uncertainty. Because you don't know whether you will get 2 rupees per share or 3 rupees per share. And chances is 50-50. So in certainty, the possible events and possible probability of their occurrence are not known. And risk and uncertainties are different from each other. Risk consists of 2 components. One is systematic risk and other one is unsystematic risk. The systematic risk is caused by factors external to the particular companies and uncontrollable by the companies. Uncontrollable by the companies means what? That is, maybe natural calamities, maybe war. You don't have any control on war as well as natural calamities. So these are the external factors and uncontrollable by the company. You cannot control. So this type of example is the example of systematic risk. And you know, this type of risk will affect the whole market, not a particular specific company's industry, but the whole market will be affected by the systematic risk. Then what about the unsystematic risk? Unsystematic risk is the factors which is specific and unique and related to the particular industry or company. Like, suppose ABC company has a labor unrest. But ABC company's labor unrest will not affect the labor unrest of XYZ company. It means this is a unique risk, unique factors which is being handled by the managers of a specific company. So this labor unrest, maybe the manager of the specific company can control. So this type of risk are unique in nature, specific. So this type of risk is called unsystematic risk, and this type of risks will not affect the whole market. Is that clear? That risks are 2, that is unsystematic and systematic. Now, risk in business, means of assessing risk, vary widely between professions. They may define these professions. For example, professions doctor, profession engineering profession. Excuse me. So doctors manages medical risk. Civil engineer manages the risk of structural failure. So professional code of ethics is usually focused on risk assessment and mitigation. In the workplace exists incidental and inherent risk. So at any workplace, incidental and inherent risks are there. Inherent risks have a negative effect on the operating profit of the business. But incidental risks are those which occurs naturally in the business but are not part of the core of the business. Now, risk in finance. In finance, risk is the probability that an investor's actual return will be different from the expected return. This includes the possibility of losing some or all of the original investment. You may lose the whole investment or may lose part of the investment. So possibility may be anything. It is usually measured by calculating the standard deviation of the historical return or average return of a specific investment. So we will measure this risk by calculating the standard deviation. So the fundamental ideas in finance is the relationship between risk and return. The compensation required by investors to invest in ventures where returns are not certain is over and above the compensation they require for the pure time values of their money. The greater the amount of risk that an investor is willing to take on, the greater the potential return. It means when you take more risk, obviously your return will be high. If you take less risk, your return will be lesser. Like my father don't want to take more risk, so return is less 4%. I want to take higher risk, might be my return will be higher than 4%. So the reason for this is that investors need to be compensated for taking an additional risk. So if I will take additional risk, that will be compensated with higher return. Investors require a rate of return that reflects the time value of money, their risk taking, and the third one, the purchasing power loss due to inflation. For example, a government treasury bond. This treasury bond issued by the public sector. Number 2, the commercial papers issued by the private sector. Now, which one is more riskier and which one is less riskier? Where you invest the money is safer as compared to more risky. So obviously, if you invest your money in public sector company, your money is more safer as compared to the money which you are investing in private sector company. So obviously the government treasury bond is considered to be one of the safest investment, and when compared to corporate bond, that is the bond issued by the private sector provides a lower rate of return. The reason for this is that a corporation is much more likely to go bankrupt than the government, because the risk of investing in a corporation bond, that is in private sector, is higher investors are offered a higher rate of return. So when you are investing your money in corporate bond, your return will be higher as compared to the investment in government treasury bond. So now from the perspective of the possible variability in the expected outcome, for example, a government bond that guarantees its holder, suppose 100 rupees interest after 30 days, so has no risk, since there is no variability associated with the return. An investment in the firm's common stock that may earn over the same period from 0 rupees to 100, 200 rupees is very risky due to the variability of the expected return. The more certain the return expected from an asset, the lesser the variability, and therefore the lower the risk. It means when the variability in return is less, it is less riskier. Where the variability of return is more, that is 0 to 200, it is more riskier. Is that clear? Now, how you measure the risk? Risk is measured with probability, which is merely a number that represents the chances of occurrence of different possible outcomes. Probability gives hints about the intensity of risk involved in investment. Now, what is probability? Probability distribution describes the outcomes and their associated probabilities. As for example, if there is one company XY is considering investing 50,000 rupees in additional inventories. If this investment is made, it can avoid some inventory shortages. Let's call this investment the investment X. Based on some research, we believe the rate of return to be earned on investment X is directly related to how the Indian economy performs in the near future. Now the lower table shows the possible rates of return on the investment the firms plan to make and the probability for the possible performance of the national economy. Suppose there are three states of economy: bad, average, and good. And there are few probability also, and probability of return is also different. Suppose in the bad state of economy, the rate of return is 0 because the economy is very bad, so return is 0. So how much probability you expect that your rate of return is 0%? Suppose 20%. Now come to the second state of economy, that is average. In average state of economy, when the economy is not good, not bad, average, so I'm expecting 10% rate of return. And probability is how much? Maybe 60%. Now the third economy is not bad, not average, but good. So in this economy, how much return you are expecting? Maybe 20%. So what's the probability of 20%? Maybe 20% probability is also. So if I would like that in all three states of economy, what should be, because we expect out of 100%, 20% maybe state of economy may be bad. 60% out of 100%, 60% average economy, and 20% is good economy. So out of 100% we have the probability 20, 60, 20. So now in this situation we have to calculate the expected rate of return. So expected rate of return, first of all we have to probable distribution, may be summarized by measure of central tendency. And central tendency refers to the value that the outcome tends to cluster around. There are several measures of central tendency, but finance usually emphasizes the importance of the expected value. So expected value is the probability weighted average of the possible outcome. So we have to take the weighted average of the possible outcome. So expected rate of returns, x is equal to ex is equal to what? That is expected return is equal to summation of probability I and xi. X probability, p is probability and x is return. That when you multiply probability and return for bad, average and good, I is maybe 1, 2, 3, 4 and maybe number of years, and I is equal to 1. So when n is equal to number of possible outcomes, I is the ith possible outcome. So how we calculate expected rate of return? That is the summation of all three states of economy. That is 20% probability is 0% rate of return, that is 0p, probability is 20, 0.2, and x, that is rate of return, is 0, plus probability is 60 in average, return is 10%, 0.1, plus probability is 20, state of good economy, and probability is rate of return is 20%. When you add all these three, the expected return will be 0.1, that is 10%. So we can say that investment with a higher expected value, the expected values, expected rate of return will be high, so considered to be better, and one with a lower is worse. Now we calculate the measurement of dispersal. Dispersal refers to the spreading or scattering of the possible outcomes in the probability distribution. In other words, dispersal measures how likely it is that an outcome will vary from the central tendency. Let's see two of the widely used dispersal measures, the variance and standard deviations. So in risk we have to calculate two variations and standard deviation. How we calculate variation? Variation is the summation of probability multiplied by return minus expected return whole square. So variation of x is equal to pi, that is probability, I is equal to maybe 1, 2, 3, 4, multiplied by xi means return, I 1, 2, 3, 4, minus x bar means expected return whole square. Now for investment x, the variations of the possible return we should calculate. So variations is equal to what? Probability is 20%, 0.2, multiplied by return is 0 minus expected return is 10%, 0 minus 0.1 whole square, plus average 60% probability, return is 10%, 0.1, expected return is 0.1, so return minus expected return whole square, plus good state of economy 20% probability, return is 20%, 0.2, expected return is 0.1, 10% whole square. When you calculate all this, add, you will get 0.004. This is your variations. The variations reflects the likelihood that the actual values of x will vary from the expected value. And to how great a degree. The lower the variation, the more likely it is for the actual and the expected return values to be similar. It means the variation is less, it means the difference between actual and standard will be very low. If the variance is very high, it means the difference between the expected and actual return will be very high. So here we are observing that variations is very low, that is 0.004. Now we have to calculate standard deviation. Standard deviation is nothing but the square root of the variance. So standard deviation is equal to standard root of variance. As you have already calculated that variance is, you have calculated 0.004 root under, and when you take the square root of 0.004, that will come to 0.63. So standard deviation is 0.63. Now we calculate coefficient of variance. When comparing, now we have to compare one with another one. Coefficient of variance when comparing a number of investment opportunities. When you are comparing one investment with other investment, then we have to calculate coefficient of variance. So when comparing a number of investment opportunities with a number of expected return and risk, the coefficient of variance should be used. So coefficient of variations standardize the risk per unit of return and may be considered as a complete measure of risk. So coefficient of variations of variable x is equal to standard deviation divided by expected return. So for investment x, the coefficient of variance is equal to, as we have already calculated, standard deviation is equal to 0.063 divided by standard deviation we have already calculated, that is 10%, 0.10. So coefficient of variation is equal how much? 0.63. Now, because I have already told you that coefficient of variance is required to calculate when we want to compare one investment with other investment. So let us add another investment venture Y to our investment X based on our earlier assumptions under three different economic climates, that is bad, average and good. For investment Y, in bad economy, the probability is 20% and rate of return is -10. In average, probability is 60% and return is 10%. Good economy, probability is 20% and return is 40%. So, like for investment X, like we have calculated expected return of X, now we calculate expected return of Y. So when we calculate expected return of Y by adding probability 0.2 multiplied by minus 0.1 plus probability 0.6 multiplied by 0.1 plus 0.2 multiplied by 0.4, when you add all these, we will calculate expected return as 12%, that is 0.12. And when we will take the square root of 0.12, that is variation, will be equal to 0.02560. And when we calculate standard deviation, that's square root of 0.02560, it will give you the picture of 0.16. And when we calculate coefficient of variation, that is standard deviation divided by expected return, here 0.16, standard deviation of investment Y divided by expected return is 0.12, 12%, and this coefficient of variation is 1.33. Now we have calculated the coefficient of variations of X, that is 0.63, and coefficient of variations of investment Y is 1.33. Now we have to analyze that which investment is better for investment. Obviously, I have told you that where the variations is more, that is higher return. Now we are comparing investment X with Y. When we compare investment X with Y, then we reveals that Y has a higher expected rate of return. Why? Because variance is higher. Coefficient of variance is 1.33 in investment Y and in X 0.63. So investment X, the variation is 0.63, lesser than 1, and here for investment Y 1.33. So because the variance is high, it means high return, and obviously the risk will be also high. So when we compare X and Y investment, we come in conclusion that Y has a higher expected rate of return, but also higher associated risk also. If only one of X or Y has to be selected, the coefficient of variance would serve the purpose. Since X has a lower risk per unit of return, that is 0.63, than that of investment Y, that is 1.33, which one you should prefer? Because each and every investors want lesser risk. So when we consider lesser risk, then X is the best investment because here the risk is lower. So X has a lower risk per unit of return, so X should be preferred. The one with the lower coefficient of variance is the best one. Is that clear? Now we should consider risk and return for the following financial assets portfolio. So we are concentrated on the individual risk assets considered separately. Most investors actually hold a portfolio of assets. Portfolio refers to group of assets, that is set of securities such as stocks and bond held by an investor. Portfolio weight refers to the percentage of portfolios total values in a particular asset. Investors tend to own more than just a single stock, bond, or other assets. We need to measure portfolio return and portfolio risk. So first of all, we want to calculate portfolio return. Take one example. Let's consider a simple portfolio composed of the two assets, that is two securities, security X and Y, which we have already discussed. Assume that the portfolio X and Y is composed of 50% investment in each. That is, we want to invest 50% in X and 50% in Y. So out of 100% weight X is 50%, 0.5, and weight Y is 50%, 0.5. Weight of investment in portfolio should sum to be 100, that is 1. It is possible now to calculate the expected portfolio return. So expected portfolio return, how you calculate? The same way like the previous one. That is what? Portfolio return is equal to weight of X and expected return of X. Weight of Y and expected return of Y. The weight of X is 50%. And expected return, you remember how much we have calculated? That is 10%. that is 0.1, plus weight of y, again 50%, that is 0.5. Expected return, how much we have calculated? 12%, 0.12. So the if we take the return of x, expected return of x, that is 10%, expected return of y, that is 12%. But because in our portfolio 50% of x we are considering and 50% of y we are considering, so we will take the 50% weight multiplied by expected return of x and 50% weight multiplied by expected return of y, and in this way we calculate the portfolio return. So portfolio expected return is equal to how much? Neither 10% nor 12%, but 11%. That is average. Other things being equal, higher portfolio return value would be desirable. So when the portfolio return is higher, that is more desirable. Now we calculate portfolio risk. In order to measure portfolio risk, we need to compute the necessary measures of co-movement, that is correlation and covariance. In discussing expected values and standard deviation, a concept, we have focused on individual probability distribution or variables. Now we consider how two variables move together. This co-movement concept is very important in developing the concept of risk. Co-movement refers to the association of the movement between two variables. These two measures of co-movement is correlation and covariance. So first of all we want to calculate correlation coefficient. But I think this video become very large, that is more than half an hour. It will be difficult to upload on YouTube or Facebook. So now we will stop here only and we will discuss the correlation and covariance in the next lecture. Thank you very much.